in my opinion, everybody should read these annual letters that Buffett puts out there. Obviously, hands down, he's one of the, if not the greatest investor of his generation, and he's one of the best ever. Period. On just creating a conglomerate, and I encourage everybody, that listens to this, go through the read his annual letters. The most recent one just came out this Saturday, and a couple of things that stood out to me from his perspective. First of all, Frank, you got to give him credit, since on the first page they put the compounded annual gains against the S&P 500 since they took over management. Overall gain from 1964 to 2021 for them is a little over 3.5 million%. which hell, the S&P did 30,000% over that time. So nothing to balk about, but nothing quite like them. The main thing that I want to take away quickly is on the Cliff Notes version of Daniel's opinion of this is that he does such a great job, and he has for years, on trying to convince people to think about buying stocks as buying businesses, like the entire business. So you can own a portion of businesses, like one of their biggest holdings is Apple. They don't own Apple entirely, they own a portion of it. But he looks at it and views it as if they were buying their own company. He wants a solid business with great economics and a great CEO. If you look at Buffett's stature in the building blocks, and he goes through this in his letter. He talks about it a lot through his insurance CEO, Geico, and other businesses with the Pilot. But you focus on CEOs. You and I have talked about this a lot. We go through transcripts all the time during earnings season. You want to see what management is saying. Yeah, typically they're cheerleaders. That's part of their job, is to be upbeat and be successful, or sound exciting, be a little salesy. But when Warren Buffett is telling you, hey, they invest in people, they buy companies, they let the people continue to run them as if they're own, that's something special. And I say all this to get to two great companies here in a minute. But a couple of things, Frank, real quick. Did you know that Berkshire pays roughly $9 million a day in taxes? So Buffett always walks this fine line about taxes. This is one of the many reasons I respect this guy, because he comes across in the media, projects him as the nicest guy in the world, and he's one of the best cutthroats and businessmen in the world. So I respect the thing on how he pulls the strings and puppet master on that. He talks about the insurance and how the float, generates their massive earnings, because all the money, or a huge majority, billions and billions that they earn, or not earn, but collect and then invest for shareholders, is basically for free because of the insurance quotes. You ought to read through that. He does a great job talking about that. Share repurchases, Frank. This is what I want to talk to you about. And this is what I wanted to highlight, because for the last several podcasts, I've been talking about the low-hanging fruit for the environment we're currently in and going into, i.e. higher inflation. I don't know how you have more of a risk-reward standpoint, Frank. Argue if you will. How is Berkshire Hathaway not one of the best companies set up to just start putting money to allocating during what we're expected with inflation stuff, across insurance, across railways, all that kind of stuff? Where do you stand on that as a low-hanging fruit that nobody cares about, because it's like recommending Amazon and Apple? People are going to say, I don't want to listen to for this. Everybody can think of that.
I think it's a good idea. I mean, if you're looking at the holdings, the one thing that does worry me, they got a very, very big position in Apple now. And Apple, I don't know if Apple is so much of an inflation hedge. That's, it should be cyclical. It's one of the few technology companies that comes out with new products and able to significantly raise their prices and maintain those margins forever. Yes, they're getting into services and things like that, and which is becoming more of a percentage of the portfolio, but it's still relatively a hardware company. You have banks, which are good, even though they're trading at 52-week lows, and we have massive inflation, which is a surprise, but everything's getting nailed right now. Coca-Cola is another good name. I mean, you have dividends, and not only that, you're seeing, with Buffett here, and I got some numbers here. Yeah, they bought back $6.9 billion of its stock in the fourth quarter alone, bringing that year-to-date total to $27 billion, and they're going to continue to do that. Some of the things that I saw, and hopefully that answered your question, but some of the things I saw there is, he highlighted how, of course, rising interest rates are going to dramatically impact markets, which I think some of us know, not all of us know. And we're seeing that to the effect just in November from the Fed saying that they're going to raise rates more aggressively and tighten. And what's happened to the market? We've seen, we look at Starbucks and Nike and Home Depot down 25% plus from their highs. And it's impacting all stocks, not just the bad ones. He said something else that was very surprising. So he has, in terms of buybacks, also within Apple, I thought this was really cool because he said his ownership is a mere 5.55%, up from 5.39% a year earlier, which seems like nothing. He goes, sounds like small potatoes, that increase. But consider that each 0.1% of Apple's 2021 earnings amounted to $100 million. We spent no Berkshire funds to gain our accretion. Apple's repurchases did the job. But he also highlighted how he's not really, even now, he's not really finding a lot of ideas.
Exactly, yeah, which leads to the $140-some billion in cash.
Yeah, so you're going to see more buybacks. Yes, it is a good place. And, you know, your expectations were, hey, you know what, remember we had 8% annually. You know, those are usually returns to S&P 500 dating back to 1950s. The last 3 years, though, we've seen massive gains of 30%, like 19%, and I think it was 26% 3 years in a row. It's, you know, again, you got to revert back. You can't continue with those gains. And this is a company that's well positioned. And again, everybody just laughs at this guy for so many years and years and years, right? And you see all these new investors say, this guy's not Kathy Woods and stuff like that. Not that she doesn't respect Buffett, but it's just funny to see how, you know, he finally got into technology. I don't know if Apple was his idea or the portfolio manager's idea, but, you know, that made the whole portfolio, that made the gains, and these guys are doing great. Now, really quick, because of the buybacks. And we're going to get the stocks. We might run a little bit long in this podcast, but the buybacks, Daniel, I want to talk to you about, because that's a massive, they're saying it's a massive catalyst, but let's go over, because the last 2 quarters alone, okay, last quarter we had a record, I think it was $260 billion, $500 billion was spent to buy back stock in the last 2 quarters. Think about that. That's how strong the company's balance sheets are even today. Right? So 30% of that was from the Googles, Apples, and Microsofts, right, which led the way, but you're looking at Meta purchased $20 billion worth of stock when shares were above 300. And where is it? Around 200, a little bit above that. Maybe Starbucks, Cisco, Charter, they're buying back massive amounts of stock last quarter. You know, stocks that have gotten hit. You're going to see another record year. If you're looking at the full year, $870 billion was spent in 2021 to buy back stock. And $500 billion in the last 2 quarters. And if I had to guess, you know, over those last 2 quarters where we are now, those stocks are down. Most of them are down significantly since then. So you're going to see more buybacks come in, and which they should come in at the right time because these stocks are down tremendously, and you're seeing companies raise dividends. That's something to look at, because that's a catalyst that people aren't talking about, where I think it's more than 80% of the companies are now outside that window where they can now talk about it and announce buybacks. And that's why you've seen a lot of companies, you know, announce these buybacks now. So you're going to see that. I think that's a big catalyst in this market, where some of these names are good names that are down tremendously. And, you know, we'll take that to earnings, because I know you want to talk about Ross and also Nordstrom. Nordstrom's up 30+%. Ross had really good numbers. And I know you want to talk about some of the earnings, but, you know, now's a good time. Maybe, you know, maybe these companies buying back stock now, but Nordstrom up 30% today, but it's still down 30% plus from its highs.
And Nordstrom had a huge short interest. I believe it was over 20% going into that
taken
print.
Over. I think I covered that a while ago. I haven't looked at it in a few months, and then I don't know, they made sure that wasn't going to happen or whatever it was. But
I like your stats on the buyback. I didn't realize they were that high. And one last point here: Buffett has done a great job over the years about pounding the table, for lack of a better term, on, you know, buybacks can be used to help earnings per share, because, you know, you're just shrinking the number of shares. Therefore, all else being equal, your earnings are going to go higher per share because you have less numbers. And Buffett is always talking about and reiterating the fact that you want to buy them back at attractive prices. If you buy, you know, for your example, if you're buying your stock back at 300 and now it's 200, obviously in the short term, you can say, oh, well, we overpaid. You have to give that time to play out. But over time, you want managers that are good allocators of capital. And so my point here is Buffett, they've repurchased 9% of the shares outstanding since 2019. Buffett has. And they bought back year to date $1.2 billion as of February 23rd. And he says our appetite remains large, but will always remain price dependent. My point is that for us average investors, if you have the greatest investor buying back his stock right now, that's an easy path to follow. On your share repurchasing thing, a lot of them coming out of blackout periods. I think it's brilliant. And to your point, Ross stores, you want to see them buy them back at the right price. So if you have Ross, ROST pulled up, you see a chart there. It has sold off significantly from its recent 52-week highs. I point all out because they just came out with good earnings, solid earnings. Guidance was a little rough, but what did they do? They announced a $1.9 billion buyback. They announced a 9% increase to their dividend. Management said that they're getting back to normal on store reopenings going forward. And after 2023, they expect to return to double-digit earnings per share growth. Now, all things else being equal, FactSet, as of the 25th of February, on their wonderful earnings insight that you always call out, basically for cyclical year 2022, earnings per share are expected to grow around 8.5%.
Mm-hmm.
Ross is telling you that they're buying back shares that they've sold off since recent highs. They're getting back to normal on store reopenings. They're raising their dividend, and they expect double-digit, higher than market average earnings per share growth going forward. When you have people spelling it out like that, put that on your radar and make sure you pay attention to that, because that's exactly what you want to hear going forward as a investor in a wonderfully run business.
Yeah, if you're looking at, and we have the chart up here now, we're looking at a stock that went from 134 to 80 to 86, right? And now it's at 96. So people are like, wow, the company just reported great earnings. It's up 7%.
And it is up 7 or 8% today, yes.
Big deal. I mean, the stock has gotten murdered, and you're seeing those numbers are good. They have a dividend. They're buying back, right? I think they're buying back stock. If not, I mean, they raise a dividend, buy back stock.
Yeah.
They announced, massive growth plans, opening up more stores. This is something that does very, very well if you've been in these stores during, times. If you're thinking that times are going to get tougher, this is a place that people shop. This checks off all the marks of a business. And this is when I say I'm seeing ideas that I've never seen before, like just incredible ideas in a very, very long time. This is what I mean. The market's terrible right now, but a company like this that's getting it done, just reporting great numbers, and only less than 10% off its highs. With that quarter, you're seeing that, right? So when things do get better and we have some kind of certainty, this thing's going to shoot up to its highs again, right? So these are the stocks that you want to invest in. As long as you have a 12-month time frame, you're scaling in. This is a good name.